The points are that the borrower does pay points, but those go to an originator that found the deal. That's all the money they make is it is the person that finds and closes that loan. They make an origination fee.
Let's talk about some of the stats. So let's start with what's the average LTV on each deal? Are these first positions versus second positions? Are they personally guaranteeing the loans? What's the average interest rate return? If I raise my hand, how quickly can I get the capital out? Just give me some stats.
Yeah.
I put $1 million in tomorrow. What's the cash flow? Is it per month? Is it quarterly? Kind of break it down there.
Sure. And so it's one of those things where it's a way lower minimum. You want to put $1 million in, no problem, Brett. I'll give you my phone number at the end of this, no problem. I'm kidding, but it is $50K minimum, so it's a low minimum bar for investors. And there is a let's see, LTV. The highest LTV I have is 60% LTV of total project cost. And so sometimes you'll go in. A lot of times these bridge deals will go in on deals where it's like you're acquiring for a certain number, and then you were doing a certain amount of renovations. Typical hard money deals, like we will do, will lend a part of that construction and a part of the purchase price of the property or the current value of the property. We just like to see some skin from the borrower, some of their own cash into the game, whether that comes on the acquisition side or on the construction side. So that's number one. It's almost always a first position lien. Of the dozen loans we have, one of them is not in first position. It's in second, and we're still sitting at 40% LTV in second position. So if we're going to go to seconds, it's likely an even lower LTV hurdle that we like to see. We charge the operator 12%. And we do a profit share with our investors above the pref that we have of 8%. So there's a hurdle of 8% that all the money goes to the investors. Anything above that, we split that above the 8%. We split that with investors 50-50. But again, like I said, no fees. The points are that the borrower does pay points, but those go to an originator that found the deal. That's all the money they make is it is the person that finds and closes that loan. They make an origination fee. So that's a win for them as well. And we get us and our investors get all the interest on the loan. So That's what's great about it.
Okay, cool. So it sounds like it's about 8 to 10% or 8 to 12%. With the split, maybe let's call it 10, because if it's at 12, the origination, there's no fees that goes to the originator, and you guys are loaning mostly first positions, 60% LTVs. Is that a fair summary so far, Matt?
Yeah, it is. And what's different than many of the other hard money loan funds that are out there, there's plenty of hard money funds that provide a great sense of security. You can compound the returns, but those funds typically pay a flat rate of 6 to 8%. What I like about what we've done is if we can negotiate a better interest rate with a borrower, our investors win. They get a percentage of the upside. They're not making just a flat pref on their money. They're making the pref and then some. Which in this deal is the pref of 8 plus a share of the profit of the upside. So that's what I really like about it.